This week, we're going to cover off three messages. UK economic data, we'll have a word on Article 50, and then we'll talk about markets. UK economic data last week told us two things. One, that rising inflation is now above the Bank of England's 2% target, and secondly, that retail sales held up quite well in spite of this. February inflation printed at 2.3%. Most of this was a pass-through of sterling weakness into imported goods, so things like laptops and holidays. However, retail sales held up quite well at a 4% increase on last year. Now, we do expect inflation to rise towards the 3% level in the course of this year. However, the jobs market is solid, so in spite of the fact that wage increases are not keeping pace with inflation, consumer sentiment is healthy, spending will slow, but it will not collapse. Against this background, with Brexit uncertainty on the horizon, we would expect the Bank of England to keep interest rates on hold for the foreseeable future. The Prime Minister triggers Article 50 this week, which formalises the UK's exit from European Union. So this starts the clock ticking on at least 2 years of negotiation and transition period. Now, Mrs. May has primed the markets for a hard Brexit scenario. She has famously said, "No deal is better than a bad deal." We have seen from institutional data that investors are historically very short sterling. So on the back of this, we think that a lot of bad news is in the price, and we believe that sterling is cheap. We are progressively switching out of and locking in profits on our international assets, bringing them back into sterling as appropriate in portfolios. Markets experienced some uncertainty last week, questioning Mr. Trump's ability to deliver on his promises. So let's put this into perspective. Equity markets fell of the order of 1.5% over the course of the week, which is a wobble compared to the down 6-7% type weeks we had in some markets at the beginning of 2016. We are overweight equities in our portfolios, so we have participated in the 10% post-election rally. We are cognizant of the risks that markets have become over-enthusiastic about Mr. Trump's reflation plan, but his administration have inherited an economy in good shape where recession risk is not imminent. So if we do get a correction, we would view this as healthy and an opportunity for us to add or to buy into positions that we like.